If a business is a riskier investment than its peers, then it may increase its payout to compensate investors for the risk they're taking, but problems come if the dividend is not sustainable. And a particular warning sign is when the firm has a large pension black hole compared to the overall company size. Prior to its collapse, Carillion was yielding a hefty 7.7%, more than double the FTSE All Share.Russ Mould, investment director at A.J. Bell, says Carillion's yield drew a lot of income seekers to their doom. The dividend was cut to zero as the profit warnings rained in and the shares collapsed. Simon McGarry, senior equity analyst at Canaccord Genuity, says Carillion's pension deficit wasn't the only reason it went under, but it was a sign of the trouble the company was in. A large deficit could be the canary in the coal mine for companies, which may be forced to cut dividends. A large pension deficit is bad for two reasons. First, it has to be filled, and that's a drain on cash which might otherwise be used to invest in the business. Second, a big liability on the balance sheet is a major deterrent to any would-be buyer. Both factors can hold the firm's share price back, and that's often when it will start hiking its dividend to attract investors. But if that dividend is being paid to the detriment of the company's finances, then debt spirals, becoming a burden on profits and, in the worst cases, causing collapse. Donald Maxwell Scott, technical investment manager at broker Rowland Ardington, warns pension deficits are presenting more of a threat to a company's health, with as many as 1 in 10 FTSE firms struggling with a ballooning deficit. The AA has a pension deficit equivalent to an eye-watering 42% of its £940 million market capitalisation, and, at the same time, has a dividend yield of 6.1%. Tesco's deficit, meanwhile, is equivalent to 39% of its £17 billion valuation and BT's 38% of its £26 billion market cap. Startlingly, Maxwell Scott adds, if BT's pension deficit was a company, it would be large enough to be in the FTSE 100. To avoid getting into a sticky situation, it is vital investors do their homework before buying shares in any company. key things to look at are a firm's net debt, cash flow and dividend cover. But a large pension deficit isn't a definite sign you should avoid investing in a company. After all, as interest rates rise, it is likely that the gaping holes in these funds could narrow. Still, companies also need to be demonstrating they are working at plugging any gap in their scheme. This week, for example, defense technology company Kinetic revealed that, after making recovery payments to close the deficit, its pension scheme was back in surplus, while BT is working on a pension settlement with staff which could reduce its liabilities. Mould adds, investing in shares means you are buying partial ownership of that business. If you wouldn't buy the whole business, assuming you had the resources, because you don't fancy taking on the pension deficit, then you must ask why anyone else would.